let's start with the class. I am hoping that I am audible, my screen is visible, everything is okay. So let's start with the class, and if you have any type of doubt, you can ask me out in the comment section. So if I give you the overview of this market risk, that what is market risk? Market risk is that risk in which when the factors in the market changes and that changes gives the loss to the organization or the banks, that is called market risk. Means this is the type of loss which is basically happens just due to the changes in the market factor. That is called market risk, right? So bank hold securities, bank hold derivatives, currencies, commodities in their trading book for short-term profit. For short-term profit, banks usually hold these things in their trading book. Trading book, a bank trading book consists some types of financial instruments like securities, derivatives. Why? For short-term resale. Profits earned from the price movements, and hedging is also there from other trading positions. So these are typically proprietary positions which are taken by the bank for the trading purposes, right? So we can say that proprietary positions in the financial instruments, and that is called the trading book, right? So these exposures are subject to several risks, mainly market risk, liquidity risk, where the shortage of cash, and credit and counterparty risk is that risk in which one party is fails to pay the obligations. That is called like one party fails to fulfill their obligation. That is called counterparty risk or credit risk. So what do you mean by the market risk? This is the risk of loss in the value of trading positions due to unfavorable movements in the market prices during the time taken to liquidate those positions. So, market risk is the risk of loss in the value of trading positions due to unfavorable movement in the market prices. What market prices include? Interest rates, equity prices, foreign exchange rates, commodity prices. Bank mark their trading portfolio to market value. Any adverse movement reduces the profit or creates the losses. That is called market risk. If any type of adverse movements are there, that can obviously reduce the profit and creates the loss situation. We can see the example here. Just a second. I think now I am audible. Now voice is okay. Please confirm that now audible. I changed the mic. Maybe now I am audible. Let me check. Okay. So, thank you for telling me. So, we are discussing about the market risk. Market risk, when the changes are there in the market factors, unfavorable changes that cause loss, is called market risk, right? And any type of adverse movement reduces profit and create the losses. If we see the example of this, suppose that a bank hold government bonds in its trading book, right? Now when a government holds the basically some types of government bonds in its trading book, interest rate rise suddenly and bond price fall. So bank records an MTM loss, mark to market loss. Market risk here materializes. Another example we can take here, suppose a bank is holding US dollar positions.
Domestic currency now strengthen. So in this, value of the US dollar position falls. That creates forex market risk, right? So this is the example of market risk. You can just think that whenever the favorable situations are not there in the market, or any changes are there in the market factors, that changes causes loss, which is called market risk. Okay. Now, liquidity risk. Liquidity risk is basically when the bank is not able to pay cash, or bank is not having enough cash to fulfill their obligations, or difficulty in selling the assets quickly at the fair prices. Assets are not able to sold in the market at the fair prices. That is also called liquidity risk. Liquidity risk in the trading book, trading liquidity risk has two components. First, we have asset liquidity risk. Asset liquidity risk arises when a specific instrument or asset becomes illiquid. Asset liquidity risk arises when a special instrument or asset become illiquid. Illiquid means that particular asset is not able to sold in the market at fair prices, right? Market is liquid, but for that asset the problems are there. So that problem with the asset itself, not with the market. What are the causes of it? Because there are complex structured products, there is very low rated corporate bonds, customized derivatives are there, instruments are there with the limited buyers. That is called asset liquidity risk. Market liquidity risk, when the entire market becomes illiquid, when in the entire market there is no liquidity. Even even in normally liquid assets cannot be sold without large price impact. Means if the asset value is suppose 90,000 rupees, but in the market the value of that asset become only 10,000, selling value become only 10,000. So that is the problem of market liquidity risk. This problem is system wide, not asset specific, whereas this asset liquidity risk is asset specific. So what are the causes of this? Financial crisis, panic selling, withdrawal of market makers, sudden regulatory or economic shocks. So suppose if a bank is there who is holding hold bond which is issued by a small private company. The bond market overall is active, but very few buyers are interested in that bond. Bank must sell at heavy discount or cannot sell quickly. This is called asset liquidation risk. Whereas market liquidation risk, you can take the example, suppose during the 2008 financial crisis, which is global financial crisis, even government securities faced poor liquidity. Buyers disappeared, there are no buyers available in the market, or bid ask spreads widen sharply, prices falls distractly. That is called market liquidation risk, which is basically systemic wise, right? System wise, not with the particular asset. So asset liquidity risk cause is specific asset illiquid, when one asset become illiquid. Market liquidity risk, when the entire market become illiquid. Market conditions in the asset liquidity risk are normal because only a specific asset is not able to sell in the market. But when the stressed or crisis situation is there, in the market liquidity risk. Example, low rated corporate bond is the example of asset liquidity risk. Financial crisis is the example of market liquidity risk. Right? Now, what is the meaning of this credit and counterparty risk? Credit and counterparty risk arises in trading book when arises in the trading book, when obviously the main issuer or the borrower defaults, right? or when there is the downgrading in the credit rating, downgrading in the credit rating which reduces market value, right? When there is a downgrading in credit rating which reduces the market value, right? So we can say that this risk exists even without an actual default. So that is credit and counterparty risk. Now, what is credit risk? Credit risk when the issuer of the security or the borrower is not able to pay interest or the principal. When a bank hold bonds of a company, the company become financially weak, probability of default increases, bond prices fall, loss to bank. Right? That is the example of credit risk. When the borrower is not able to pay the bank's principal or interest, that is called credit risk. Now, counterparty risk, when the one party is not able to fulfill their obligation, risk that the other party in the financial contract fails to meet the obligations. When a bank enters into an interest rate swap, the counterparty defaults before the settlement, bank suffers replacement cost loss. Right? And also, there is one important thing, rating the downgrade risk. Means rating the downgrade risk, that means even without default, if credit rating falls. What is credit rating? Credit rating is basically is the history is given to the borrowers according to the history of the borrower. Credit rating falls, example, if someone having the rating AAA to BBB, right? Now investor demand higher yield, right? Then bond prices falls, right? Or MTM loss occurs. Means here we can say this is called credit migration risk. Now the thing is there, what is the meaning of this MTM? MTM, mark to market, right? Mark to market. What is the meaning of this mark to market? When the investments are there according to the current prices in the market, whatever the actual price that is there for the asset or any type of investment, right? That is called MTM. Now, very important thing, market risk management frameworks in the banks. How to do a market risk management framework? Because obviously for a bank it is very important to see that this any type of risk is properly identified, properly measured, properly monitored, controlled, and as well as mitigated, right? So first step is here risk identification. First step is risk identification. Identifying all the types of market related risk that the trading book is exposed to. Identifying that all types of market related risk that the trading book is exposed to. It includes interest rate risk, equity price risk, foreign exchange risk, commodity price risk, liquidity risk, credit spread risk. Means risk identification, in which very first step is just to identify all the risk, right? So what is the example here? Example is a bank trading in forex identifies the exposure to exchange rate volatility. When a bank trading in forex identities, and that is exposure to exchange rate volatility. A bond trading desk identifies the interest rate risk. That is means the very first step in every risk management is just to identify the risk, that what type of risk is that. Then the next step is, here we have risk measurement, because after identification measurement is important. Risk measurement. Now in the risk measurement we can say that quantifying that how much risk the bank is taking, and the very common tool for that is value at risk, right? Just a second. Value at risk. What is value at risk? That is the tool which is basically tells about the maximum expected loss under normal market condition. And one more tool is there, stress testing. What is stress testing? Losses under the extreme conditions, and also sensitivity measures. Sensitivity measures like duration, beta. Here value at risk shows the bank suppose may lose rupees 10 crore in one day with 99% confidence. A stress test shows losses during a crisis scenario. That is called risk measurement. Then third step is monitoring and control. Now continuous tracking of risk level and ensuring they stay within approved limits, where the key controls are trading limits, stop loss limits, position limits, independent risk management desk. Suppose if a trader has a limit of 100 crore exposure and exposure crosses 90 crore, alerts now are generated. It breaches require senior management approval. Means 100 crore exposure is allowed only, not more than that. Then last step is mitigation, reduction. All the steps are taken just to remove that risk or reduce this risk, because completely elimination is not possible. But yeah, steps can be taken to mitigate that risk. So methods are hedging using derivatives, diversification, reducing positions, improving asset quality, increasing liquidity buffers. So bank hedges interest rate risk using the interest rate swap. Foreign risk is hedged using the forward contracts. That is called risk mitigation, right? So market risk that arises from the price movements, liquidity risk that arises from the inability to sell the assets quickly, credit and counterparty risk arises from default or downgrade. So a strong market risk management framework ensures financial stability and also protect the banks from large trading losses. Clear? Now, Organization structure, market risk management. An effective market risk management system in a bank requires very clear rules, independence, and a strong oversight, obviously. The structure ensures that the risk taking, risk measurement, risk control are properly separated. First, top prior level, we have board of directors. Board of directors, they are having the complete responsibility of market risk management in the bank. They approve overall risk appetite of the bank. What is this risk appetite? Risk appetite is the willingness of the bank. Willingness of the bank, that the bank can take that much limit of risk. It also approves market risk policies and frameworks. It also ensures adequate capital allocation for the market risk. It reviews major risk exposures and limit breaches. So, board of directors having the overall responsibility. If the bank decides to increase trading in derivative, the board approves maximum exposure limit and what is the capital required for such type of activity. Then we have risk management committee, a committee of the board which is responsible for policy level supervision of risk. A committee of the board responsible for policy level supervision of risk. It reviews market risk reports periodically. It monitors the compliance with approved risk appetite. It ensures independence of risk management function. It reviews stress test results and value at risk trends. So if the value at risk increases sharply in the movement markets, that risk management committee evaluates whether trading limits need tightening or not. Then we have ALCO, Asset Liability Management Committee. This is Senior Management Committee. Senior Management Committee, that is basically responsible for managing balance sheet and market risk. It manages interest rate risk, liquidity risk, foreign exchange risk. It sets the trading limits and also the stop loss limits. It reviews the market conditions and always also funding strategies. It ensures profitability is there within the risk limits. Example, suppose if interest rates are expected to rise, so ALCO may reduce the long term bond holding or increase floating rate assets, right? Then we have ALM support group, market risk group. This group provides analytical and technical support to the ALCO because it helps in measuring the market risk. It prepares the risk report for the ALCO and the senior management. It monitors limit utilization. It conducts scenario analysis. So if a group calculate interest rate sensitivity of the trading book and then submits reports to the ALCO, right? Then middle office, which is independent risk control unit, which is separate from the front office, because front office is mainly trading desk. Middle office is doing daily mark to market valuations. It's do value at risk calculation and monitoring. It limits the compliance check. It reporting to breaches to the management. So if a trading exceeds approved limit, the middle office escalates the issue immediately. Right? So risk identification, when all the market risk associated with the products and activities and they are recognized before the trading. But what is this product program? Product program is a detailed document that defines what are the product features, what are the characteristics of the risk, what are the operating procedures, what are the limits and control. All the standard products must have an approved product program. Risk taking units must operate strictly within it. Right? And one more thing is there, which is PTM, product transaction memorandum. What is it? Basically, this is a temporary approval document for the new products. For non-standard or complex products, it is used until a full product program is prepared. So if a bank wants to start trading a new derivative, it first have to approve or operate under the PTM with some restrict limits. Got it? Now, risk measurement happens with two types of things. First, we have sensitivity, which how much the value of a portfolio changes due to small change in the risk factor, and downside potential, which measures possible losses under the uncertainty. Value at risk is the maximum expected loss. uh, Basically it tells about the maximum worst loss that the bank can face, right? And why this value at risk is very useful? Because it protects the depositors, shareholders and the bank franchise. It converts the complex exposures into PNL impact. It aggregate all the risk across products and market. It meet regulatory and disclosure requirements. It is accepted by the banks, regulators and academicians. It provide a probabilistic measure of loss, but not a worst case loss. It ignores all the market conditions. It assumes that everything is normal. It does not indicate the size of loss. It should not be used alone. So it should be used with stress testing, scenario analysis and sensitivity analysis. Now the important concept is there, back testing. What is the meaning of this back testing? It is the process of comparing value at risk predicted by the risk model with the actual profit or loss of the trading portfolio. Basically it compares the process of value at risk predictions and whatever the real model is there. So it helps to check how accurate and reliable the value at risk model is. Why the back testing is done? Just to evaluating a new value at risk model, to assess the accuracy of an existing model, to identify the model weakness, to comply with the regulatory requirements, and actual losses compared here with the value at risk. If the actual loss exceeds value at risk, that is the exceptional case. Right? Then back testing always checks whether the predicted risk matches reality or not. Stress testing measures the impact of extreme but plausible market movements on the portfolio. It gives the banks that situation, that how the banks will react in the worst situation. It captures all the tail risk. It assesses the capital adequacy under the stress. So if interest rate rise suddenly by 3%, equity market price falls by 30%, currency depreciates by 20%, so that resulting is calculated, which is called stress loss. So market condition in the value at risk is normal. In the stress test, it is extreme. Probability, yes, used in value at risk. In stress test, there is no work of probability. In value at risk, focus is expected loss. In stress test, basically the severe loss. And what makes a good stress test? Obviously, relevancy, which covers all the key market variables, which considers the regime shifts, which considers the market illiquidity, and also capture interaction of the risk. So what is the limitation of the stress testing? That there is no probability assigned to stress outcomes. Stress scenarios may appear arbitrary, which is very difficult to compare stress test results across the bank. Very high IT and system cost. This stress testing is judgment based, not the statistical. And then risk monitoring, which is very important to do the risk monitoring. Risk reporting is the last step, which every report of the risk should be timely, accurate, which include written commentary, concise, and also it should be focused. And the thing is there that value at risk measures only the normal risk, right? Stress test measures extreme risk, whereas back testing validates the model accuracy. So you can say that what are the risk mitigation strategies are there? Strategies: use the sensitivity measure, use the correlation measures, and use the market instruments, right? And obviously reports need clear communication of the risk, which all the things must be communicated to the board of directors. So that is it in this market risk. I hope that you understand this chapter, and tomorrow we will do chapter 15, all the important concept, in just few minutes. So I hope that you like this session. If you like this session, kindly give the like. If you have any issue, give comment, and just read the PDF to understand the basics and about the chapter. So thank you so much. Let's meet in our next class. Till then, take care and have a good day all. Thank you.